Hey everybody, it's Seth and Paul for the Everything Money channel. By the end of this video, you will know everything, the ins and outs of the financials of Disney as a company. Paul, I know you love Disney. I love Disney. Everyone loves Disney. If you're a Disney Plus subscriber, you probably love all the new shows as well as I do. But by the end of this video, you're going to learn the financials behind Disney. What happened to them this year? What is their income? What is their revenue? What is their profit margin? And is their stock a buy or an avoid? And Uncle Paul will tell you that. Paul, how are you? I see you're in Mexico as well. How are you, my friend?
I am wonderful. How are you? Do you have Disney Plus?
I do have Disney Plus. I enjoyed it. You know, we went through the gamut. We watched it a little bit, kind of got through everything we wanted to get through, then got rid of it. Then we came back on. But do you have it? You love Disney?
I mean, listen, my brother and sister-in-law love Disney. And in the new house I just bought, they have that Disney room that we're going to like leave for the girls. But yeah. I mean, I've only been to Disney World, Disneyland a few times. My brother goes every year. In fact, my brother goes every year with his wife, even before they had kids. Like, they just love it so much. Like, my brother has that whole pass thingy where he goes there and stays there and all that stuff.
Yeah, your brother is bonkers about this. But what we really want to find out, Paul, for our listeners, we welcome you in. For our subscribers, we welcome all the new subscribers. I'm in Akron, Ohio, where we're based out of. Paul's in his Mexican mansion, which I will be visiting this Saturday. Paul, I can't wait to see you, of course. And kick your ass in tennis, of course. It'd be wonderful.
Well, we can see each other right here.
You'll be kicking my ass in tennis, really. But in general, guys, we're going to look at Disney. We're going to go over, use our 8-pillar analysis of this company. If you're buying stocks just on trends, where every other person on YouTube just keeps writing 3x, 10x, 19x your money. Paul, why does that upset you when everyone just writes, just buy this stock, it's a 20x stock? I mean, you have informed me over the past many years that making money is usually quite difficult. It shouldn't be easy. And so when you see these 20x type thumbnails, what do you think about these people saying this?
Well, making money is easy and difficult, but if it's too easy, I'm always apprehensive going, okay, making money shouldn't be too easy. And when I hear people say 10x, 20x, it's clickbait. All they're trying to do is get you excited. And if it doesn't work out, they have an excuse. It's like, oh, the market did this, the market did that. I'm just a big believer as a value investor that over the long run, a stock is going to do what's behind the stock, the financials. And over the short run, it's a popularity contest. It's whoever's the most popular is going to win, regardless of what's going on with the company financially. I mean, look at Tesla. The company only made money this year because of government rebate, and the stock is up 600% this year, 500% this year, and they're going to start losing money again. It's just unbelievable to me that people just buy into the hype. But it's good clickbait. And, as boring as that may be for us, it's the right thing for me. I sit there and say, I believe in buying. When you buy a stock, you're buying a piece of a company, so you should care how the company makes money and might lose money.
All right, Paul, let's get into it. What is the market cap for Disney?
All right, so Disney's market cap is at an all-time high of $321 billion. And I don't talk about the stock price very often, but I want everybody to see this. The company is currently at an all-time high of $178, all-time high, even though their parks have been shut down. It got as low as $85 a share here in March, and it's doubled since then. This is a shutdown company. So they have no PE. Why? Because they haven't made money in the last year. And their profit margin is negative because they haven't made money in the last year. So these are two big X's to start. But with a company like Disney, I'm not going to put as much value into the current PE and current profit margin because it's because of a shutdown that was completely beyond their control and completely one of the black swan events. For a company like Disney, you want to focus on, as a stabilized company, what's it worth. You still want to factor in how it's doing right now because it's still going to cost them money. They're going to lose money as they get back to normalcy. But you don't want to just sit there and say, oh, it hasn't made money, it's worth zero. This is where most people would sit there and say, but Paul, if it doesn't make money, you should think it's worth nothing. No. A stock is the present value of its future cash flows. It will be back to cash flow positive at some point in the next year or two. That's what I'm valuing the company based on.
Keep going, Paul. Pillar number 3 is revenue growth over the past 5 years. Would you
so they
exclude
recently
this year?
Closed their year end, which was September. If you can see here, 55.6 billion, and now they're at 65 billion. So even with the drop of revenue of the last year, they still have a big check mark there for revenue growth.
How about profit growth over the past 5 years, Paul? Pillar number 4.
Now, profit growth is a different story. 9.4 billion down to a loss of 2.9 billion. So it's definitely an X there. But look at the last 10 years. Look at this, 4.8, 5.7, 6.1, 7.5, 8.4, 9.5. I mean, they're very consistent profit growth, which I love.
How about shares outstanding, Paul? This is the number of shares, pillar number 5. We want this going down.
Now, it was going down for a long time, but it's back up again. So this is an X. But I bet they're doing this as a way to fund their losses. They're probably issuing shares as they go up to fund their losses, which I don't blame them for. But I still don't like it.
Pillar number 6 is current assets greater than current liabilities, Paul.
Total current assets, $35 billion. Current liabilities are $26.7 billion. So plenty of cash on hand to pay off their current liabilities. Muy bien.
Pillar number 7 is free cash flow growth, Paul. This is cash from operations minus capital expenditures. Okay,
so their free cash flow was 5 years ago was 8.4, and now last year it was 3.6. So an X there. But remember, the last year had COVID, so I still am surprised they even had positive free cash flow. So for us, what we're going to do, free cash flow is cash from operations less capital expenditures. It's the money you're going to use for dividends, stock buybacks, acquisitions, even more growth, et cetera. So you want to see free cash flow and you want to see a reasonable number. Now, one thing I want to discuss is, Seth, Disney Plus. At the beginning, in what was it, October of 19 or November of 19, how many Disney Plus members were there?
Yeah, so in November of 19, there were 10 million subscribers. When just a month later, there were 26. And now this month, Paul, there's almost 90 million subscribers at Disney Plus.
Okay, 90 million subscribers, each paying $8 a month. That's $720 million per month. Times 12 months, you're looking at almost $9 billion a year in extra revenue. And it's Disney Plus. The gross margin is probably very high on that one. So I can understand to a certain level, people bidding up the stock very high, but you got to remember the parks are still, for the most part, shut down. Like, I think Disney World's open, but Disneyland in LA is closed still, correct?
That sounds familiar. I definitely see Yahoo's going to Florida and hitting up Disneyland. So yeah.
Okay, so let's do the average over the last 5 years. But again, this is skewed. I might let's just look at this though. So you ready to do you have your calculator out, stuff?
Go ahead, Paul. Yeah.
So let's do 8.4.
This is the free cash flow growth, folks. 8.4.
Yep. 8.4, 8.7, 10, 1. And 3.6.
Divided by 5 is the free cash flow average is 6 1/3.
Okay. Now, since it's a lot lower lately, and it's probably because I don't get the 2019, because 2019 had no COVID, but it still had a major drop in free cash flow. I'm still going to multiply this by, so everybody, the most common question I get is, why'd you pick 20? 20 is merely because our PE, we want a 20, and over a long period of time, your earnings and your free cash flow should be pretty similar. It should match up pretty similarly. So if we look for a 20 PE, I want to look for a 20 price of free cash flow.
So folks, Paul, just to dumb that down, let me make sure our folks get it. So if you're wondering, we find the free cash flow average, folks, then we have to multiply that times a certain number to give us the value of the company. And that value can be compared to the market cap to see if the company is over or underpriced or over and undervalued. So Paul usually picks around 20. Are you going with that number now, Paul, for pillar number 8?
No, I'm not. I'm going to go with a higher number, and here's why. Disney Plus is going to be a huge boon to the company. It's going to make them a lot of money. And once the parks reopen, you can make the argument that they're going to go right back to generating the free cash flow numbers and higher than they were before. Because if you have the parks open and you were generating 9 or 10 billion, now you're adding Disney Plus. Let's say that adds $4 or $5 billion to free cash flow. I'm assuming, I don't know what the exact number is, and this is part of the extra research you need to do. You're talking about 13 or 14 billion in extra free cash flow, in total free cash flow. So based on this number right now, I mean, at 6 1/3, multiply by 30, maybe. I mean, maybe this is a $200 billion company. I don't know.
Yeah, 190. The market cap is 321, Paul.
So I do still think it's overpriced, and here's why, guys. It's at the highest level ever, with a big part of their business revenue being shut down while they're still paying a lot of operating costs. But in this time, Disney Plus is increasing and doing well. The question you have to ask is, once the world gets back to normal, will there be as many Disney Plus members? I don't know. Netflix has still been a very growing entity, and at $8 a month, that's not a lot for your kids to have all these Disney shows and everything. I mean, and they're still going to grow worldwide. Do I think this is a $200 billion company? Yeah, I think so, but it still needs to drop today to about 120 or 130 a share. I'm much more comfortable to where it was in October. Do you see where it was in October? It was at 123. Like, I'm much more comfortable sub 120 on Disney. Now, does that make it, if you look at my analysis sheet here, let me pull that up for you. This is my model that I created. This model it takes the last 5 years of quarters and extrapolates out based on growth and other factors in there. The average growth rate has been 3.9%. The average profit margin has been about 13%. Now let's go look at previous years. I'm going to pull this up without even bothering you guys. In the last few years, the average profit margin has been about 20%. So this is still very low, guys. I do think, let's put this at 20%. I mean, guys, yeah, back to the 120 number. I think this is a 120 PE. I think this is a 120 company all day long. Not all day long, but I think if you're at 120 or so in the stock price, which is where it was 2 months ago, Seth. It was there 2 months ago.
Yeah.
I don't think this is a bad stock to keep your eye on. And especially as the vaccines come out, it's going to make the world open up more. I just feel apprehensive paying record prices for a company that's already rich in premium during a shutdown. That just doesn't add up to me. I think there should be a discount because we still don't know when the shutdown will stop. It could take a long time. Who knows?
Yeah, so in general, folks, looking back with a $321 billion market cap, their PE ratio is non-existent. Their profit margin is currently non-existent, but they do have revenue and profit growth. They are issuing more shares, pillar number 5. They're good on current assets over liabilities, and they have no free cash flow at the moment, which all of this results in the highest stock price it's ever seen. So this is a sign of the time, Paul. What is this telling you about just the general market?
I mean, that's just, like you said, it's a sign of the times. Like, people are just gung-ho about the market. They're trying to, it's euphoria. And this is definitely an issue. But I do think Disney is, when stocks do fall, if you can buy Disney for 100 or 120 a share or lower, I think you're going to do very well over the long haul. And I also think that as they grow and grow and grow and generate this free cash flow, they have to do something with it. And what's that? Give it back to investors somehow. I think they'll be buying back shares again when things turn around, they get reopened, and I think they'll be paying a dividend at some point.
If you love what you hear, the analysis and the financials behind this, all we ask is just tickle that thumbs up right below. It's so simple. If you love what you're hearing, subscribe. And as always, you can join our Patreon, Paul, the Patreon. As you love, you're on it basically all day. Your Patreon, you get access to Paul's portfolio, my portfolio, the calls, the puts, the options. It's all out in the open for you to see. If you're interested in, again, just studying the financials of a company, Paul, I know you're addicted to this process, and the people who've joined our Discord and Patreon channel, they just love it. And so we'd love to have you as a viewer. We'd love to have you, obviously, as a subscriber and a patron, and we'll be giving back a lot. Paul, thanks for this analysis. We sort of knew where Disney was going to be looking at the stock price, but again, it's another one of these companies that we love the company and not in love with the stock, wouldn't you say?
And by the way, I want to make a comment, though. A year ago, I was at $80 for Disney in my value. So it just shows that even with the shutdown, I've increased my value, assuming that Disney Plus, because it's grown so much, has added so much free cash flow to the company. So it just shows that over time, things can get better and you can build into a value. But if you're a value investor, your goal is to buy $1 for less than $1.
Yep.
I don't think at 177, you're buying a company that's currently worth 177. Could it grow into that value? Absolutely. But there's thousands of stocks out there. I do say keep this on your radar, though. This is a great company, a phenomenal brand. I mean, what's a better brand than Disney?
It's not.
Tell me a better brand.
It's not going anywhere anytime soon, right? The movies they make and what the experience you get at their parks is incredible. So,
yeah. So, anyways, I love it. Keep your eye on it. Buy it less than 120.
Thanks for watching, guys. Hit that thumbs up. We love you. Thanks, Paul.